Let's bring in Jay Taylor, President and CEO of Taylor Hard Money Advisors and editor of MiningsTocks.com, joining us now from New York. Here in Sydney, still our guest host, Hugh Latimer from Aurora Funds Management. Jay, let's talk about the oil price, because the move up seemed quite incredible when we had these weak consumer confidence figures telling us that the number was actually below 50, which indicates a healthy economy. So it seems as though there are still a few headwinds for the consumer. So why is oil trying to get back to 80?
My guess is there's a great deal of speculation going on, and I think it's probably a dollar play to a great extent. I mean, I don't see any real evidence in the United States that we're seeing any kind of growth in the economy at all.
Jay, for the past 2 or 3 weeks, we have seen refined products inventories being creamed off, really as a function of low refinery utilization. Is that really the reason, or are we actually seeing a snapback in demand because inventories are still considerably, there's still a considerable overhang in the big OECD countries?
Yeah, there's no question about that in my mind, that we're really looking at slack demand overall. I mean, why is the price of oil going up right now? I can't. You certainly have some growth in China and elsewhere, but from what we can see in the States, there's no real physical demand that accounts for the price of oil being where it is right now.
Jay, I might just kick in there, and you might have a view on this, but I tend to think that what we've got here is a two-tier oil economy. In the OECD nations, I saw some figures out from the International Energy Agency the other day, and they were saying that the growth expectation next year for oil demand from the 30 OECD nations, including the most developed nations, is quite tepid. But really the big demand is coming from the non-OECD countries, clearly the BRIC nations, some of the emerging economies. Are we seeing do you think, and I think we are, but do you think we're seeing the oil price rally to $80 off the back of the non-OECD demand?
Well, yes, I think what demand there is, it's coming from those countries, from the BRIC countries. I don't think it's coming from the developed countries yet. And then I think there's a great deal of speculation. I think that money is going into commodities in general because of a lack of confidence in the dollar. Now that could change. I personally believe that the short dollar trade is somewhat crowded, and we could see a stronger dollar. It could catch a lot of people by surprise. Whenever you get so many people on one side of the market, usually you can figure that sooner or later it's going to tip the other way. And I think we could be close to that.
Jay, let's talk about the broader metals space, because we did see the Case-Shiller Home Price Index, widely watched by markets overnight, actually rising, indicating a tentative recovery in the housing market in the US. Does that give you confidence about the demand story that's playing out from the housing picture?
No, I think essentially what we have is an artificial demand in the housing markets. The intervention by the government, and I understand we passed the extension of the housing credit was passed to first-time home owners. This is artificial, as so much of what's going on in the U.S. is artificial. So it doesn't give me a lot of confidence. All I think they're really doing is delaying the inevitable and buying some time, probably not allowing the markets to self-correct, not allowing this recession to come to an end.
Jay, we saw a pullback in the price of gold, and many people are saying that's a good opportunity to get back in. Are we seeing a bit of a base forming around 1,030, and is that going to provide us the springboard to move higher and possibly take out fresh peaks?
Yeah, well, I'm a long-term bull on gold, and I don't, in the short run, I don't know where gold's going, but I can tell you that we're printing. The Obama administration, the Federal Reserve, and countries around the world are printing money like mad. And it seems to me, for those that look at history, that what we're in now is something like a 1930s beggar thy neighbor situation, where all the countries are trying to gain an advantage against the next by cheapening their currency, by printing more and more of their currency. And to me, that's really bullish for gold. Where it goes in the short run, I don't know. But you look at the trillions of dollars of bailout that the Obama administration is putting forward to bail out large corporate interests. I just think you're cheapening the currency, you're debasing the currency, and I think that's bullish for gold long term. So where it goes in the short run, I don't know. I would be a buyer, and in the short run, I would look on these times of weakness to add some gold. I certainly would. And gold shares as far as that goes too.
Okay, so play for the tangible inflation hedge. Thanks for joining us today. Jay Taylor from Taylor Hard Money Advisors.